Most people have seen those videos online. This ETF will make you rich. You only need these 3 ETFs. ETFs are everywhere right now, and honestly, they can be powerful tools for building wealth. But here's what almost nobody talks about: the small mistakes people make when investing in ETFs. Mistakes that don't hurt right away, but quietly drain your money year after year. And the worst part? Most investors don't even realize it's happening. Today, we're breaking down the biggest ETF mistakes people make: hidden fees, misleading performance charts, volatility, and the real risks behind some ETFs that get recommended everywhere without proper explanation. So if you actually want ETFs to work for you instead of against you, stay with me until the end. Welcome to Extra Money, where investing is explained in a simple, practical way. Quick note before we begin: this is not financial advice, just education to help you make smarter decisions. Let's start with mistake number 1: assuming an ETF is well diversified without checking what's inside. A lot of people believe all ETFs are automatically diversified. And yes, compared to buying a single stock, ETFs usually spread your risk. But not all ETFs are diversified in the same way. Some are much more concentrated than others, and that difference matters. The easiest way to see this is by checking the ETF's fact sheet. It shows how many companies the ETF holds, which sectors they belong to, and how much weight is placed on the top holdings. Let me give you a simple example. Take 2 healthcare ETFs. The first one holds around 65 companies. Sounds solid, right? But most of those companies are large, established names, and the top 10 holdings alone make up more than half of the entire ETF. Now compare that to another healthcare ETF that holds roughly 400 companies, including large, mid, and small cap stocks. In this case, the top 10 holdings make up less than half of the fund. Both ETFs focus on healthcare, but one is much more concentrated, while the other spreads risk more evenly. Neither is automatically better. The key is knowing what you're actually buying. Mistake number 2: thinking ETFs are risk-free. This one catches a lot of people off guard. Even broad ETFs that track the S&P 500 or the total stock market can lose a lot of value during downturns. During the 2008 financial crisis, the S&P 500 dropped around 50%, and even in more normal market corrections, 20 to 30% drops are common. Many investors see ETFs and think, it's diversified, so it must be safe. That mindset becomes dangerous during market crashes. When prices fall fast, people panic, sell at the bottom, and lock in losses they could have avoided by staying invested. ETFs reduce company-specific risk, but they don't eliminate market risk. If you're not comfortable seeing your portfolio drop temporarily, there are safer options like bonds or savings accounts, but with much lower potential returns. Mistake number 3: ignoring fees and commissions. ETFs are known for being low cost, but that doesn't mean they're free. There are 2 main costs to watch. First, the expense ratio. This is the annual fee charged to manage the ETF. Passive ETFs that track an index usually have very low fees. Actively managed ETFs, where managers pick stocks, often have much higher costs, sometimes over 1% per year. Second, trading costs. Depending on your brokerage, buying and selling ETFs may involve commissions or transaction fees. And this connects directly to the next mistake: ignoring tracking error. Tracking error matters most for passive ETFs, the ones designed to follow an index. If you're investing in an ETF that tracks the S&P 500, you expect it to closely match the index's performance. But not all ETFs do. Tracking error is the difference between the ETF's performance and its benchmark. Small tracking error isn't a big deal. Large tracking error means you could earn noticeably less than the index, even though you thought you were investing in the same market. Tracking error can happen because of fees, rebalancing delays, or liquidity issues with certain stocks. That's why lower tracking error is usually better. Mistake number 5: focusing too much on past performance. This is one of the most common traps. People see an ETF that returned 20, 30%, or even 50% last year and think, this is the one. I need to buy it now. But markets don't work that way. What performed well last year may underperform next year. Instead of chasing returns, focus on the ETF's strategy, diversification, holdings, and costs, and whether it fits your long-term goals. Mistake number 6: trying to time the market or investing without a clear plan. Many investors wait for the perfect moment to buy. The problem is, that moment rarely shows up. People hesitate when markets are rising, buy emotionally after big gains, or panic sell during downturns. You've probably heard this before, but it's true. Time in the market beats timing the market. Studies show that missing just the 10 best days in the S&P 500 over 20 years can cut your returns almost in half. A consistent strategy, like investing regularly and staying invested, usually works far better than trying to predict short-term movements. Mistake number 7. Investing in leveraged ETFs without understanding the risk. Leveraged ETFs aim to amplify daily returns, often 2 or 3 times the movement of an index. That sounds exciting, but here's the problem. The leverage resets daily. When markets go up and down, gains and losses compound in a way that can seriously hurt long-term performance. Even if the index ends up flat over time, a leveraged ETF can still lose a significant amount of value. Because of that structure, leveraged ETFs are generally not suitable for long-term investing, especially for beginners. And there you have it, 7 ETF mistakes that can quietly eat away at your returns. If this helped you see ETFs more clearly, let me know what you think. Your feedback always helps shape future videos. If you found value here, consider liking the video and subscribing for more simple, honest investing content. Thanks for watching. I'll see you next time.